Okay, we'll go ahead and get started here. Good afternoon, everyone. Thanks for joining us for another episode of Coffee with Carl. We're excited to welcome back Phil Argue, Director of Investment Strategy with SIA, as he joins Carl for an in-depth market update and discussion and thoughts on areas of opportunity for 2026. Welcome back, Phil. We're glad to have you with us.
Thank you for having me back. Appreciate it.
Thanks, Phil. Yeah, we'll go ahead and get this kicked off. This year, while the market, I think is slightly positive on the year, I've been talking to clients and people have been, pretty confused by a lot of the volatility. It feels like the market could be down 20%, even though it's, still in the positive. So, I'd love to take some time if you could go through and just kind of unpack what's been going on with the market, and then just walk us through and give us a little bit of color on as to how you guys are combating that, and what your expectations are for 2026.
Sure. So I have a lengthy slide deck. So I mean, and I won't go through every slide. And if it's okay, I mean, I'm happy to stop and do questions, and it's probably better than me just sitting here talking the whole time. So let me just share my screen real quick here. And all right. Let's see. Let me get a little laser pointer thing. Okay. Carl, you got me?
I got you. Yeah, you're good to go. Perfect.
Okay. So yeah, I think Carl, the way you described it is kind of the sentiment everywhere, where yes, the market is right about flat on the year, maybe just slightly positive. But underneath the surface, there has been an unusual amount of volatility with, certain things going up at an extreme amount, certain things going down. We'll talk through, the magnitude of that, and we'll provide some context there, and then also talk through, what we think is the driver of that. I'm going to come back to this slide because we did make a number of changes in January, but I want to come back to that. So I don't want to start off with what happened in January. So the chart on the right-hand side here, we basically take a number of different indices that are tracking U.S. equities, international equities, different pockets of the stock market, so individual sectors on the right-hand side here, and each one of these groups is organized by the return in 2025, so with the highest return at the top. And then on the left-hand side of the chart there, we've got the year-to-date return. And everything outside of international, everything in the US, whatever was the best performing index or asset class in 2025 is among the worst performers this year. So, obviously, let's see, communication services, technology, all the Mag 7 names were up, 25, 30% last year. They're, slow coming out of the gate. But then down here, you've got energy that was up, close to 9% last year. It's already up 24% this year. Consumer staples up 15%, materials as well. So there is this huge rotation happening under the surface. And the reason for that is probably a couple fold. We've used this chart on the left-hand side. Our team kind of tries to sort of summarize all the economic data, all these hundreds of data points we have. We think the real big question is over here on the left-hand side. So the graph on the left is GDP growth. We got an update on GDP growth just the other day. And the gray line is nominal GDP growth. So just all of the goods and services that were sold in the country on a year-over-year growth. So nominal growth was 5.1% in the most recent quarter. It was up here close to 9% in the third quarter. And we've been in this environment where the economy has been slowing. This blue area, the rate of growth has been decelerating. And in that environment, companies that can grow revenues and grow earnings at a faster clip tend to get more and more capital allocated to them. So, in that environment, you don't want to own something like Southwest Airlines. You want to own Meta or Amazon, or these names that can grow revenues, right? However, with the passing of the One Big Beautiful Bill, a lot of these tax incentives that come in, we're going to have probably the largest tax refund season this year in the U.S. there is this expectation that, hey, economic growth is going to accelerate. And we did get a reading of that back in the third quarter, this little bleep where economic growth accelerated. That was kind of a one-off. It was really due to imports. Nobody's importing any goods, and so, but the market has started to anticipate, hey, maybe we're going to be up in this top bucket up here, where you want to own something like Southwest Airlines, because when they generate a little bit more revenue, they can generate a lot more profits off of just a small increase in revenue. They've got a lot of fixed costs. They already got to pay for all their airplanes, but if they can get a few more people in their planes, a lot more of that additional revenue goes to profits. And so that tends to benefit more value-oriented stocks. And so the market's really wrestling with which one of these two buckets are we looking at? This green outcome or the blue one. And so just to illustrate this on the right-hand side, I took those 11 sectors and we kind of break them into three groups. Our early cycle group, energy, financials, materials, and industrials. If the economy is reaccelerating, you would expect this group to do well, right? They are tied to nominal GDP growth. The late cycle group, if the economy was kind of slowing down, kind of like we were over the last few years, you'd want the gray group, which is consumer discretionary, technology, and communication services. That happens to be where all the Mag 7 names are. And then lastly, we have our defensive group down here. Now, we are getting this rotation where discretionary tech and communication services are rolling over, and the early cycle group is really accelerating. Now, the concerning part with this is it kind of looks a little bit like late 2021 back here, where 2022 was a bad year for the stock market. We had kind of runaway inflation. The Fed was going to have to, chase inflation higher by raising rates. And so we are seeing not just strength in the early cycle group, but also the defensive group down here as well, which it's almost like a bipolar market. Are we excited about faster economic growth? There is a contingent that is also going towards more defensive oriented equities that gives us a little bit of caution. So to give you a sense, this graph here takes every member of the S&P 500 and plots them as a dot here, these tiny little gray dots. It kind of looks like a line here, but they're organized by highest return all the way to the lowest return on the right. And yes, there is a stock that's up 150% already year to date. It's SanDisk, so you don't have to go Google it, but it's a memory company. There's been a big memory shortage, obviously. But so the point here is all the Mag 7 names are down here. This was as of a couple of days ago, so maybe one or two of them turned positive, but they're all negative on the year. But the median stock is up 7.1% year to date. So while this rotation has been painful for the trades that had worked last year, it's actually working for most equities. And this is not just a U.S. phenomenon; it's happening, kind of around the world. International markets are performing phenomenally well. And just to touch on that, if we went back here, I mentioned U.S. equities are seeing this big rotation. International markets, international value. So you think, industrial names in Germany, or European banks or Japanese equities fall into this international value. They were up 43% last year. They're already up 10% this year. So we've seen this sort of persistent move towards more value-oriented types of equities and less towards the growth names. And so what's causing all of this? And we can talk about, AI and, what's happening. But I think the biggest thing is everybody was super bullish and everybody got really excited towards the end of last year. One big, beautiful bill, accelerated depreciation for all of these, for companies that want to spend money. So they get a big tax cut. Consumers are going to get a big tax refunds, over the next couple of months. And so everybody had piled into U.S. equities. And what happens is if you look at the size difference of some of these different markets, because the U.S. is so much bigger than everybody else, on the right-hand side, this is the market cap. So what would it take to buy all of the stocks in the Russell 3000? Comes out to about $65.5 trillion, okay? The next biggest group, international developed. So think every country outside of the U.S., not including emerging markets. So exclude China and South Korea and, some of these other, smaller ones. they're at 23 trillion. But the Mag 7, just 7 names, the biggest 7 names in the US are equal to, in value, just about, all international developed countries combined. And then you think about some of these things that have done really well this year, energy stocks are only $2 trillion. So if investors say, hey, I'm going to take a small little percentage out of my growth allocation and I'm going to go put it in energy, let's say if we took $1 trillion out of the Mag 7, that's about a 5% allocation. If we took 5% out and we put it into energy, that's a 50% increase in energy. And so this is a byproduct of sort of everybody being super optimistic at the end of last year. And then just the size difference, how much capital is in one, US equities, but also in the Mag 7. So those are off to a slow start this year. I wouldn't say that this is something that I would bet that's going to continue for very long, but I think this is sort of the explanation for how you could get energy names that are moving up 50% year to date, and then you get these Mag 7 names that are they're not down 50%, they're down just a little bit, but the amount of capital that's moving between them makes a big difference on some of these smaller parts of the market. And in terms of international equities, same thing happens here. If we want to take 5% of our US allocation and move it to international, it makes a big difference in international equities. So that provides a little explanation for, I think, the mechanics of how this is happening. And I mentioned everybody was really excited about US equities coming into the year. And this was on the first slide that kind of shows some of the changes that we made to our portfolios in January, which I'll circle back to. But one of them is just valuations coming into the beginning of the year were lofty. And everything is expensive. Whether it's financial assets or anything outside of financial assets. But the Russell 1000 growth, all the growth stocks, was trading at 35 times 2026 earnings. If you look back over the last 20 years or so, that's in the 98th percentile. Basically, valuations were extreme, which isn't necessarily a bad thing. Like that's everything is expensive, and so when everything's expensive, you can't just take your chips and go home. We gotta invest in the market that we're given. But on top of those earnings, the valuations, earnings expectations were for 20% earnings growth this year. So we had lofty valuations on really lofty earnings expectations. And in our view, we thought the margin for error is just pretty narrow here. So we did take down some of our US equity exposure and go overseas. And I think this is a story that started last year that I think most people US based investors don't fully understand.
Can I throw a question at you too?
Yeah, please.
When I do a lot of these interview series, we talk to different fund managers, and I know they all have their capital market assumptions, and a lot of folks are, projecting 10-year run rates for US equities at, 1 and 2%. So I guess, would you attribute a lot of these valuations to those long-term, goals, just because with the Mag 7 having such a large composition of the S&P, if that area doesn't grow, how do these indexes really, how does the US index really perform well? And then, does that for you guys advocate much more towards being active kind of in that large cap space where a lot of times it's been better to be, index over the last 5 years just because you really haven't seen the outsized returns?
Yeah. So I think I'm going to say every capital markets assumption exercise that you see out there is just a look back at valuations for whatever we're measuring, and looking at what was the return 10 years later if we started out at whatever valuation that was. Now, the hard part with this is like when you say, and all of these capital markets assumptions do the same thing. Say, hey, they look 10 years out or 5 years out. And they have, if you would have looked at one of these capital markets assumptions 7 years ago, they would have told you the same thing. US equities are going to be flat to down. And because equities have been just expensive for a very long time. And valuations can remain lofty until there's a negative catalyst that really jolts the market. We don't see anything like that, happening at the moment. And I think investing for what you think is going to happen 10 years from now, well, I think we have to be aware of it. I think it kind of discounts our ability to adapt to the market, over the next 6 months, over the next year. And so I think I wouldn't argue with the fact that probably over the next 10 years, some, international markets like international value, valuation's only 14 times forward earnings. That's probably going to be a better bet over the next, 10 years, certainly. But there is a whole lot of opportunity between now and 10 years from now where things are going to change. And those capital markets assumptions, if you were to do them for 1 year forward, they're pretty much useless. So valuations work over the long run. They don't tell you anything about what happens in the short run. And so I think we got to look to the future and recognize, hey, valuations are lofty. If the stock market is going down, yes, large cap growth stocks, because their valuations are the highest, they are probably going to lead on the way down. Some of these other markets that are where valuations are more reasonable, probably going to hold up better. But I think, looking at a table and saying, hey, 10 years from now, this says this, and we're going to allocate that way, I think leaves a lot of opportunity untapped in the more near term.
Mm-hmm. Thanks.
Okay, so what's happening overseas that's making things so interesting? So I think everybody knows, early last year, Trump had a real bone to pick with NATO members about how much they were spending on defense, shared defense to protect the NATO alliance. And so the U.S. historically has spent far more than all the other countries who obviously have by far the strongest military. And so Trump kind of stuck it to him and said, hey, you need to pay your fair share. And then we did the whole tariff thing. And what has sort of happened from, if you kind of tap into what European leaders are talking about, they are preparing for NATO to not exist by 2030. So I know Trump, even in his State of the Union speech, said, "Oh, I got the NATO members to pay their fair share." If you go read the plans that the European Union has put in place, they don't ever mention NATO. They rolled out this European Defense Readiness Program, European Defense Readiness 2030, and they are preparing for NATO to not exist, and they need to be able to protect themselves against potential Russian aggression. Obviously, right next door, Ukraine war still going on, and so they have a ton of different defense programs as well as social programs to bolster their infrastructure and their military so that they can defend themselves. Okay. Mm-hmm. Now, historically, on the bottom left, let me just bring a couple of charts in this. Bottom left-hand corner is our deficit. So how much more does the Treasury spend than it brings in relative to GDP? And you can see we started at like 3% way back in 2016. It got down to like 5%. COVID happened and we went to like 18% deficits. And we're working our way back up to 5%. We're expecting this to go lower again once we get all the tax refunds sent out. On the other hand, you go to Europe. I use Germany just as a proxy because they're kind of the big one. Over the same time period, these are sort of overlapping time periods, Germany wasn't running a deficit, they're running a surplus. And in the European Union, there is a rule for all the countries that are in the European Union that you cannot run a deficit beyond 3%. So what we did back in COVID, hey, just print a bunch of money and let's send checks. European countries didn't have that option. Okay, they did go below briefly, brought it back up, but as part of this European Defense Readiness Program, they put this kind of a weird name of a rule, National Escape Clause is what they call it. And basically it allows countries to deviate from this 3% deficit target for the purposes of building infrastructure and supporting this European Defense Readiness Program. So international markets are much cheaper than they are here in the US. And historically, we have been running larger deficits, which supports our economic growth. We're putting more money into the economy than Europe is. But now they've put in place a mechanism that allows European countries to play the deficit game. So they can spend a lot more money than they bring in, which is why stock markets in Europe, have gone gangbusters over the last 12 months. They've got about $800 billion in defense spending commitments already. There are new announcements every month coming out around this. And so that's why there's a bunch of optimism around, hey, international equities are cheaper. And now all of a sudden there's this big fiscal, driver coming in. 16 countries out of the European Union, out of the 28 countries, have already enacted this national escape clause. So they're committing to spending more capital. So that's, I think, a big driver that's probably going to be with us for a little bit, because this runs through 2030, and getting their defense, programs up to snuff to defend themselves is not a 6-month or 12-month thing. This will probably take the full 5 years that they rolled out. So we had kind of lofty equity valuations in the US. Everything in the international was cheap, but we got this fiscal drive from Europe that gives those equities a big boost, which is why markets are responding so favorably there. I'll give one other one. It's really just policy rates. So this, on the left-hand side, we're tracking central bank policy rates in the US is the gray line. All of the G10, so think of developed, economies. So, the ECB, the Bank of Japan, all those, they're down here. So rates internationally are lower. The one up here is emerging markets, so non-G10 countries. And they're actually cutting rates faster. So we actually did put an allocation, a larger allocation in emerging markets back in January as well, because emerging market central banks have started to cut rates at an accelerating pace. So I think that's an interesting tailwind, again, to a market that has much lower valuations. Let's see. I've got so many darn slides. I don't want to go through every one of them. Let me stop there, Carl. Any way you want to steer the conversation from here, or should I just keep?
Yeah, I mean, why don't you finish through? Is there any other slides you have on international effects, and then maybe go back through some of the positioning and how you guys are positioned in the upcoming year, and you probably just go through just those broad changes you guys are making.
Yeah. So okay. So this was I think our rebalance was back mid-January, January 20th or so, and so on the left-hand side is just a quick little summary of kind of what we've talked about. Lofty expectations for U.S. equities, 18% earnings growth. We said, hey, let's take our exposure down a little bit there. So we trimmed about 11% out of U.S. equities. We went to international value. So those areas that are going to benefit from European defense spending, increased spending in Japan as well, and emerging markets. And we did add an allocation to gold. So 5% of our equity allocation went to gold from U.S. equities. And so far, the market's cooperating. All these changes have been net positive. But these are not, I wouldn't say like our allocation to gold. I wouldn't take that as like a doomsday, scenario. I think it's just in light of equity valuations being stretched. We took the opportunity to add a piece of gold. We could go on for a while about gold. I don't have any slides on it, but I can talk through the rationale there.
Yeah, maybe just give a couple points as to the how you guys are positioning in the portfolio, and then more long term. Do you see it as more of a trade, or is it a long term hold that you foresee over the next couple of years? How are you guys thinking about just the gold, positioning within the portfolios?
So I think there are two big driving forces for the price of gold, and they kind of operate on two different time scales. So one would be just this deglobalization that we're enacting on, and so for the last 40 years, countries around the world were happy to own U.S. Treasury bills, 10-year Treasury notes, whatnot, and that was their reserve, their currency reserve.
Yep.
As we start to get increasingly more friction, around the globe, more of these central banks are deciding to allocate more of their reserves to gold. And I think it's not like the dollar is going away. If that was happening, gold would be, at $25,000 an ounce. Like this is tiny little baby steps moving to where central banks around the world just want to have a little bit of diversification. So that's one. And I would say, if you look back at the history of gold has gone really on just prior to the last 24 months, has gone on two major runs in history. One was during the 1970s when we had, runaway inflation. Gold rallied about 700% or so. The other one was in the early 2000s, between 2002 and 2011, kind of wrapped the financial crisis in there. It also went up about 700% in that run. Right now, we're up about 360% or so. So I think there is as deglobalization happens, which is a very long trend, central bank positioning, again, a very long trend. I think those are big tailwinds where I think it makes sense to have a piece of gold in our portfolios. However, there is another cycle that happens that is really driven by investor flows. Folks like us or people that are investing in ETFs, that we saw a little bit of this late last month. So shortly after we bought gold, the position rallied about 12% in 10 days, and then it came crashing back down when they announced the new Federal Reserve chair, dropped like 10% in a day. And what that is individual investors piling into gold, and there's sort of this herd mentality that happens on a much shorter cycle, where we saw a little bit of that sort of blow off sort of top late in January. It ended with a 10% decline in gold, and now gold is climbing back up again. And so I think if we were to get to a situation where we saw evidence that retail investors were being reckless with their gold exposure, we would probably trim gold, even though the long-term prospects for gold, I think, do make sense because that trend's going to be with us for quite some time. So I think there's some competing sort of ebbs and flows with gold. I think if you want to, hey, I don't want to deal with all this, you could close your eyes, put a 5% position in. I think you'll be happy over the next, 5 years. But because there are these, kind of driving forces, it's going to be a little more volatile than it was, owning gold over let's say the last 5 years when it was, a little more sanguine of a return profile. So I think just be aware of that. I don't know. How's that, Carl?
Yeah, I've also had clients ask about inclusion of like silver or copper or some of the other metals. How do you guys think about those? I mean, or is it just, hey, the standard is gold just because of, the currency trade with, a lot of companies looking for the diversification?
Yeah, silver, you could argue silver has, it is an industrial metal. It is used in, and same with copper. But they are not, I think they have the short-term cyclicality of investors, chasing these things. It doesn't have that structural long-term demand, which really comes from central banks.
Mm-hmm.
Now, if central banks for some reason decided, hey, you know what, we're going to not just add gold, we're going to add silver as well, that would obviously be a huge tailwind. But I don't know of a single central bank that holds silver as a reserve. So I think you get the short-term volatility, and those are going to be more volatile. If gold goes up 10%, silver is going to go up 30. But you are subjected to this sort of swings in sentiment, which we don't want to play. We want to play the long structural game and be cognizant of when maybe the market gets over its skis in the short term. But we want to make sure we're playing the long-term game.
No, that's very helpful. One of the questions I had from the prior slides, you were hitting on the international markets. Japan obviously has continued to perform well. I noticed you had a note about China there. Any thoughts on that? Any thoughts on that market? Seems like they've still continued to struggle from a return perspective, but you guys see an opportunity if there's a reemergence there to make it an investable asset class?
So I would say Chinese equities is extremely challenging market, and so we spend most of our time understanding the ins and outs of the U.S. equity market, where the bulk of our capital is invested. In international markets, we rely on portfolio managers that are in each of those markets to better understand, hey, what's the opportunity set in each of those. Now, the managers that we've had in emerging markets have not been overly exposed to China. They have been underweight, and we delegate that to their decision making, and we sort of review them versus a number of other managers to make sure we've got the best manager in place. I think the challenge with China, they've got this, they've got a real estate problem, a debt problem tied to real estate. Real estate markets there continue to struggle. And Xi Jinping has everybody's been waiting for them to unleash some big stimulus program to kickstart the economy. And it hasn't really happened. And so I think everybody kind of scratches their head saying, all right, Japan's doing their thing, Europe's doing their thing, the US has, got the one big beautiful bill, and China doesn't really have a policy catalyst in there to kickstart things. And so I'm sure it's coming at some point. But at this point, I think there's a lot of other opportunities in emerging markets outside of China that our managers have been very keen on and are taking advantage of. And so we look at it from big picture U.S. equity market. We're real comfortable understanding. We know all the inner workings. International, let's have somebody who's in that market, boots on the ground, and we'll make the decision on emerging markets versus U.S. at a higher level, and not worry about what stocks we're picking in there.
Yeah, one of the questions I would have is you made some of these strategic allocation moves, adding gold, increasing international. Are there any things you guys see on the forefront that could make you change some of these thesis points? Where you might get a little more defensive, and how would you approach that? So anything that could cause reservations for a big correction. Maybe walk the folks through. If they start to see X, Y, Z, markets could get a little more challenging.
Yeah. So
outside of normal volatility, of course.
Yeah.
I think we got lucky over the last 3 years where the markets have just pretty much gone straight up with lack of volatility. So I think we've been, got a little greedy in that respects. But is there anything that you think could cause some reemergence outside of normal volatility?
Outside of normal volatility, well, let's first of all, let's qualify what normal volatility is. So in any given year, the average peak to trough decline for the S&P 500 is 15%. Okay, it's like 14.7, whatever it is. So we should always be prepared for, hey, the market could be down 15%, and that's normal, right? That's not a crisis. I would say that I think we expected the level of volatility under the surface of the equity market, I will say, usually happens when the market's already down 10%. So I think the fact that, and I do have a slide on this. Let me. So there are a lot of these slides that I'm sharing with you. We also have a number of quantitative measures that we use that we don't normally share, but let me get down to one of them here. So, so this is one of our quantitative tools that we use, and we, like I said, we don't normally share because it's a little complicated to explain. But what this thing is doing, the indicator is this blue line here, and it is tracking 7 different historically risk-on type investments versus a risk-off investment. Okay, and we're tracking these 7 pairs, and we put them together in an index, and it comes out to this blue line here. Okay. Now this index goes back to 2001, and it's kind of geared towards looking at 6-month forward returns for the S&P 500. And so I don't know if you can see this, but we break it out in different quartiles. So when this index is really, really low, returns tend to be somewhat muted, right? Down 2.5% over the next 6 months. When we're way up here, returns tend to be very strong, up 16, 18%. So one of the things that we saw early this year was this index was weakening fast. Plus, we had those elevated valuations, and so some of the decisions that we made move towards international. Add gold is a defensive play, and so
Thank you.
but what we haven't gotten is a decline in the S&P 500. Fortunately, like this is probably the best outcome we could have had so far. But what is happening, what has sold off significantly is a lot of these growth names that, Microsoft, I think, at one point was down 18% this year. And what this has actually created is, so there's opportunities in kind of both directions. Coca-Cola, for example, trades at 24 times this year's earnings, 2026 earnings. Microsoft and Meta trade at 22 times earnings, right? So you could have Coca-Cola that's more expensive than buying, Meta and Microsoft. So I think there's once we get through this little patch of resetting of expectations that started the year, I think there's going to be some really interesting opportunities on the growth side of things, because we don't see any sign that we're going off of a cliff. The economy's going to crash or unemployment's going to spike, and so I think this resetting that we're seeing and this rotation in the equity market is actually creating some opportunities in some of these growth names in the U.S. That likely stage a pretty good comeback later this year. I will just mention one other thing. Midterm election years tend to be not the best returns for equity markets. That doesn't mean down, just relatively flat, and we tend to be flat through August. So once the market starts to sniff out, is Congress going to lean one way or another? Are we going to get a split Congress? We start to see much better returns in the second half of the year. So I would expect maybe a little more chop in the first half of the year, which certainly caters to our international exposure, a little bit of part of gold. But I think where we end up is late summer, the market starts to sniff out. We're likely going to get a split Congress, either the House or Senate, which would probably provide some policy stability, which equity markets love. And then maybe these growth names come roaring back, which I think is a likely outcome, just given how cheap they've become.
No, that's really helpful. One of the questions too I've been getting a lot is just and AI has had a pretty dramatic effect on some of the software names. How are you guys dealing with the AI, and then obviously financials this week take a hit due to AI? Do you see that in the near term continuing to cause volatility as it kind of rips through each of the different sectors? And then, how do you think that kind of lends to long-term performance, obviously, as there's further adoption?
So if we went back to this guy, I mean, so to Carl's point, so software, if you were to take just all the software names, everything to the right of Microsoft down here is basically a software name. And I think what most people maybe don't understand with AI, and I think everybody has played with AI at this point. Everybody gets ChatGPT and you type something into it. It's effectively like Google. But I think what people don't realize is sort of the paradigm shift is when people realize that you can use AI to write programs, or what people call agents, to run tasks for you. Okay. So for example, I could, this is what they call vibe coding. If anybody's heard of this, where, hey, I got this idea. I want to create a little tool. I'm just going to go tell, most people are using Claude, the Anthropic AI, to, hey, here's what I want to create an app that will book my travel for me and my hotel and fill out my expense report, for me automatically. And this thing will go write an application for you, and it will, all of a sudden you don't need booking.com or Expedia. This agent, while you're sleeping, can go look at every airline website, look for the best deal, find the right hotel for you. And so that's causing the fear of that is causing all of these software names to just get clobbered. And unfortunately, we had Salesforce was a name that we had that we have since sold. But who needs a contact management system, if I could just have an AI agent that knows my email, knows my contacts, has access to everything, and I could just ask it, hey, when was the last time I called Carl? And it would tell me. I don't need, Salesforce anymore. I think this in the near term has gotten way overhyped. And so I think a lot of these software names are probably due for a pretty good bounce short term. However, longer term, I think the utility of AI is going to continue to grow, and it is going to be a challenge for for companies. I don't think it's going to put it's not like all these companies are going out of business, but they are going to have to adapt, and they are going to need to quickly start leveraging these new types of tools on their existing platforms to make sure that they keep customers. So I will say, I mean, we are exploring our team how we can use these AI agents to automate sort of remedial tasks. At the end of every month, we've got probably 50 spreadsheets that need to be updated and reports sent to different people and whatnot. And we can, when we have created a little agent that can do some of these remedial tasks for us. And so I think it's very promising from a productivity standpoint. The concern is what happens if we start really displacing jobs, at a large scale. Carl, I didn't touch on this, but I had one thing. But if I just jump to one thing,
Yeah, go ahead.
So I mentioned jobs, and I didn't.
Phil, it's your show, my friend. So
okay, I'm sorry. Well, just some perspective on the labor market, because this has been the weirdest labor market for the last 18 to 24 months. And I mentioned jobs, and I think it's important to kind of level set what's going on in the labor market. So on the right-hand side is that monthly jobs number that we get every month. The last one was 130,000 jobs, way better than expected. But it came with a bunch of revisions to last year. So last year, before we got the January number, we had 584,000 new jobs added last year. And then when they came out with the January number and they revised it, it went down to 181,000 jobs. That is the slowest pace of job growth outside of a recession since 2003. Now, what's I think more interesting, so one, the labor market has been slowing. We need this thing to pick up. And if this AI adoption accelerates, are we going to get a reacceleration in job growth? And that's what people are worried about. The other aspect of this is, where are the jobs? So down here at the bottom, I've got healthcare industry. So this is, doctors, nurses, anybody in healthcare. Last year, this is after the revisions, we added about 700,000 jobs in healthcare. If you looked at the rest of the economy, it's minus 516,000, right? So not only is job growth weak, it's also very narrow. It's all in healthcare. And so I think while the stock market's making new highs, and I think part of what has caused some angst, in society is that the job market is probably not, the job market isn't as strong as maybe this, 4% unemployment rate feels like. And so I think that's what creates a little more anxiety. And I think makes people feel vulnerable. And then you get this AI thing coming along, and it gets people, maybe jumping the gun a little bit. I do think these AI tools are going to be enormous productivity drivers. But we are so far away from saying like, oh, we're gonna lay off staff and replace them with AI. Like, I'm sure some tech companies, certainly are doing that because they are tech focused and they lean into these things. But for the broad, economy, blue collar, normal, people that are not at Meta and Microsoft, there are a whole lot of people who still haven't even tried ChatGPT, even just to, type something in. So we're a long ways away from that. So I think near term, things are a little overhyped on the doom loop of software is going to die. But our labor market is fragile, and we're in this fragile state, and we really need this little reacceleration to pick up steam. Anyway, I mentioned jobs, and I just wanted to touch on that.
No, I mean, I think that provides helpful context. It certainly, as folks are tracking the market, if we continue to see down numbers on on job growth, I think that can paint a pretty telling story as to whether we get the level of growth across these companies that we need. Because I think one of the points you mentioned earlier at the start was that things need to go really well in order to map up with the earnings expectations that everyone has set out.
Yeah.
Um,
Yeah. And we probably need to see jobs, running at, probably plus 200,000 or something for that to start, for us to be on that trajectory. So, um, yeah, like I said, I've got about probably 30 other slides buried in here, but I don't want to put everybody to sleep. So, you tell me, Carl, where do you want to go
why
next?
don't we open it up too in the meantime? So, folks, if you guys want to ask any questions, feel free to raise your hand. I can and unmute you, or if you want to send it into the Q&A box while we have Phil here for the final 10 minutes, please feel free. And then I'll go ahead and pass those questions along. And then Phil, if you wanted to, I think if there was a slide or two you wanted to add as we finish up while we wait for questions, feel free.
So I'll do two more on the labor market just because I think they're interesting. Actually, let me go to the next one first. So one thing to keep in mind is the labor market, the jobs report that we get every, the first Friday of every month that everybody, pays attention to. It's a survey. And they survey about 120,000 businesses and ask them, hey, did you hire more people? Did you not? There has been a notable decline in response rates for all surveys in really since COVID. And so the reliability of these numbers has declined significantly, which is why we see these revisions, a year later.
Yeah.
So in order to get a better read on, okay, what's actually happening, the Treasury Department publishes, every dollar that comes in and every dollar that goes out. And so we went and we pulled the withholding, Social Security and Medicare withholding that comes out of W-2 employee paychecks. That's not subject to how do I feel about the president. So I'm gonna mark my survey differently. But so on the positive side, we are seeing an uptick. This is the year over year change in withholdings, Treasury withholdings for income taxes for Social Security and Medicare. And so we are actually seeing a promising trend here, up 4.5% or 4.9%. We need a couple more months of this. And I think that gives us further evidence that maybe at the aggregate level, we are turning the corner on the labor market and we are going to see a rise, which gives us some comfort there. But because it's an election year, I think it's just interesting to point this out. The job growth is also not broad-based. So on the right-hand side, this is over the last 3 months, what percentage of states have added jobs over the last 3 months? That's what this blue line is showing you. And normally when we get these big, declines, fewer and fewer states are adding new jobs. 2008, 2000, right? These recessions are periods where that doesn't happen. What's odd again is like we're at levels where we were in June of 2008 by this metric. So the job growth is not broad-based. And I put all the top and bottom states on the left-hand side, and it's too early in a midterm election year to go through and figure out which state voted for which way. But on the left-hand side is number of jobs added over the last 3 months. The right-hand side is the percent change. So obviously New York adding 40,000 jobs on a percentage basis. That's not a lot. Montana is actually the biggest growth because they have a small population. But I think this is interesting as we get closer to the midterms, how the labor market is doing in these distinct little districts is going to be a hot topic when it comes to politics later. I don't know which way it's going to go, but I think it's just an interesting dynamic that while, hey, we're saying, hey, we added 130,000 new jobs, under the surface, it is very uneven. And it likely, again, leads to some angst, for folks. And anyway, I just think it's an interesting perspective.
Yeah,
All
I
right.
mean, I think the economy is completely different for different groups of people across the country, right? There's some that are the economy's doing great, right? If they're in a pocket of the country, but if you're in the DC metro area and you had a bunch of jobs cut due to Doge, you have a completely different feeling, on the market as a whole. Um, so
Yeah, just as a point on that, Carl, I think the biggest thing, regardless of geography, it comes down to if you were somebody who bought a house pre-pandemic, it's kind of everybody talks about this K-shaped economy. You know, this group of people are, if you own stocks, if you own real estate, this has been great, right? It's been a great environment. If I'm renting and I don't have an investment portfolio that's had this huge ride over the last 3 years, but my groceries cost more, things are really tough. And so I think in our, as we've talked about this for more hours, I'd like to admit, that was sort of the how do you put a point on it? It was, if you bought a house before the pandemic, your home is probably worth 50% more today than it was pre-pandemic. If you bought a home, you have the ability to put a down payment. You probably have a stock portfolio. You're participating. Anyway, didn't mean to cut you off, Carl, but I thought that was just interesting real world,
I'll throw out, based on that, I'll throw out two more questions we can finish out. So, when it comes to catalysts, maybe that could, hurt the market, do you see a scenario where potentially real estate prices could come down? I know that could be a direct effect on the overall consumer and, how they kind of net wealth effect. And then another question would be just, I know a lot of folks that maybe have invested in Bitcoin, for example, and they're down 30% this year. They, even though the market's flat, they feel like the market's done poorly because they took on that asset class. If Bitcoin were to drop significantly further from these levels, do you think that could affect the, market more broadly since we've had more adoption? So maybe those two subsets as to how people might think about real estate or the crypto asset in relation to the overall market.
Um, well, so I don't think real estate is going to have a big, look, there are going to be pockets, right? Austin, Texas, places that, had a lot of building, in the Sun Belt, whatnot, post-COVID, we're seeing bigger contractions in price there. But on a national level, I don't think we're going to see a big decline there. If we were going to, it likely would have happened already, right? With the Fed raising rates, where they did. I think what we are going to get more rate cuts this year. You're going to get, we're right on the cusp of getting a 5 handle on mortgage rates. And so I think that should start to help. But I think the days of real estate, hey, let me go buy 4 condos and hold them for 2 years and they're going to be worth 20% more. I think we're not going back to that either.
That was one of the things I was leading into. Like, maybe as an investment class, I think a lot of folks, they look at, oh, well, I bought a property 20 years ago. I made 200-300% return. Let me go out there and do these multifamily or residential or whatever it may be in the real estate class as an investment. And then they look at the returns over the last couple of years and it just has been nothing.
Yeah. And look, I think, I guess we should caveat this with, look, if the labor market were to crack, I think things could get worse. But I think if things were starting to get worse, you'd see the Federal Reserve lower interest rates very rapidly, which would pull down mortgage rates, which should support prices. But I think that would be in an area where, like, okay, could home prices drop 10% from here on a national level? Sure, like that, but it's not going to be like 2008 where we're down 25% or something like that. Because I think the main reason is when households have phenomenal balance sheets. So the amount of debt that households have is very low relative to incomes. The problem is just prices shot up so fast for homes, and we need to give incomes a chance to catch up. And so I think that leads to sort of muted returns for real estate. If things start to get a little squirrely in the economy, the unemployment rate starts to go up, we might see a little dip. But I'm confident that the Federal Reserve will be very quick to lower interest rates and provide support there. But I think it's probably not it's not going to be the field of gains where, hey, I could just go buy a second home and, I'm going to hold it for 3 years and it's going to appreciate. But real estate's always local. So there's always little pockets of, opportunities that are happening here and there.
And then maybe on the one little point if you have any thoughts on the Bitcoin side, if there was some sort of prolonged downside, does that concern you in the markets, or you think they become more and more detached?
I don't think, I mean, I don't think Bitcoin's widely held enough to affect the sort of median consumer.
Mhm.
Um, I think, look, we're puzzled by the decline that Bitcoin has had. This has been an unusual divergence where, Bitcoin is down, almost was cut in half, where the stock market is up at all-time highs. But we've never bought Bitcoin directly. We do own a couple of stocks that are sort of have Bitcoin exposure. Um, I think we've kind of gotten to the point where I think everybody's just become, everybody's so enamored with gold and other things where it wouldn't surprise me if Bitcoin ends up having a pretty solid year this year. Especially if broadly speaking, the equity market, continues to stay steady and risk appetite stays elevated. People are going to start rotating back into Bitcoin. It's not something that we would go, allocate to directly in our models at this point. I think we still, you know, want to get more comfortable with it. But as a trade on the side, yeah, I mean, I think it's an interesting asset class down here after it's been cut in half. Probably is pretty interesting at this point.
Perfect. I think that's a good finish for the folks. Phil, as always, thanks for the wealth of information. I think the slides provide a lot of context for the viewers. So thanks as always. With that, we'll go ahead and conclude today. Thanks everyone for joining another installment of Coffee with Carl. Thanks again, Phil, and look forward to seeing everyone next time. Thank you, guys.
My pleasure. Good to see you, Carl.
All right, take care now. See ya.